Yeah, hi. So this is a problem on preparing adjusting entries. Okay, so some initial balances are given in some of the accounts, and then a set of transactions are given, and we need to prepare adjusting entries. So adjusting entries will have same format as that of the journal entries, okay, because journal adjusting entries are nothing but journal entries only. So let's create that. So I'll start with 3.5. This is the problem, and Hong Limited. So adjusting journal entries. So first important thing is what is the date on which these journal entries are adjusted. Okay, so they are adjusted on December 31st, 2020. Okay, so this is prepared on that. Okay, now what is the first transaction? So you are borrowing some amount on a 1 year note on September 1st. Okay, so when you are borrowing some amount, you have to pay interest. So what is the interest from September 1 to December 31? So entire September month is there, October month is there, and November month is there, and December month is there. Okay, so 4 months are there, right? So I will use first I will use the format here. So date and accounts, then reference and debit and credit. So let's do some calculation here. Okay. So adjusting entries are always made on the last date, so that is 31st December. So on 31st December, what is the adjusting entry? So first thing is for the first transaction, you will have interest expense. So I have to calculate the interest expense. So what is the interest? So 10,000 is your principal amount, 9% is the interest rate, that is in percentage. Okay, so and this is 9% in 1 year. Okay, so divide by 12 will be monthly this one, and then for 4 months, because September, October, November, December. So this calculation will give you the interest expense. Okay, so that will be how much? Okay, so 9 divided by 12 multiplied by 4 multiplied by here 10,000 divided by 100, because it is in percentage. So now I got 300. Okay, so whatever this 300 NT dollar, so this is the interest expense for the 3 months, because we are closing the books on December 31st. We have to do that adjustment entry. So here, yeah, yeah, so your interest expense will debit by 300, and your interest, but this expense is not paid yet. We just calculated that interest is 300, we have to pay. So interest payable, that will be credited by 300, because we did not pay interest on 31st December. It is interest payable. So this is the first transaction. So is that okay? Shall we go to the next one?
So the against thing of expense is interest payment, yeah?
Yes,
Payable.
yes. So interest expense
Okay.
is increasing by 300, and interest payable is 300.
Yeah, okay, I understand. So now always I make, if I have interest expense, I make it interest payment payable to make it against.
Yes, but if let's say the transaction is something like this, see on 31st December, paid interest expense of $500. Now what you will do? You are paying the interest expense. So in this case, here you will put cash.
Okay.
But because we are adjusting, we are not paying. We are just doing adjustment. So
Yeah.
this is interest payable, that account. Let's go to the second one. So if you see the second one, Supplies on December 31 indicate supplies of 900 are on hand. What was the original supplies? So this supply was 2450 originally. So from 2450 supplies reduced to 900. So what is the difference you have to see? So usage of supplies. So you are using 2490 minus 900, right? This much. It was 2450, sorry. 2450 minus 900 is your consumption of supplies. Okay, so that is 2450 minus 900. So 1550. Okay. So here now, where the supplies are going is it's like gasoline, for example. You purchase gasoline, now you are using them. So that is again on 31st. You say supplies expense. That increased by 1550, and from where it is expensing, it is going from the supplies, because in the assets you made supplies, right? So that will reduce. So your supplies asset will reduce by 1550 and your supplies expense will increase by 1550. That is the second one. So shall we go to the third one?
Yes, yes.
So depreciation on equipment is 1000. So we just have to adjust this accumulated depreciation. See, right now accumulated depreciation is 0. Okay, so we just have to increase that accumulated depreciation. Nothing, this thing. So that again, this is an expense. So depreciation expense increased by 1000, and accumulated depreciation.
This is what confused me. How I know it's expense or depreciation or so much.
So in the adjustment things, what you're doing is you're taking all the expenses and you're adjusting them, unaccounted expenses. See, usually when you will, let's say you have a equipment like a computer. Now at the end of the period, you have to adjust the depreciation, right? So every year it is depreciating. So that will be shown as a depreciating expense. You don't have to pay this amount. This amount will be anyway anyway the amount will be reduced from the what you call retained earnings.
Okay.
So here is that one. So next, let's see, one more expense is there. Huang paid 21 for this thing. Just a minute. Yeah.
Okay.
Yeah. So now let's come to number 4. 2100 for 12 months of insurance coverage on June 1st. Okay, so now from June 1st to December 31st, 6 months is already over. So whatever you pay, or not 6 months, actually even June month is counted, right? So 7 months. June, July, August, September, October, November, and December, 7 months. So this 2100 is your prepaid insurance. Out of 7 by 12 is what you already got the expense, insurance expense. Okay, so that will come to 2100 into 7 by 12. So that is 1225. So this is an expense. Okay, so let us show it as an expense first. So 31st December. So insurance expense, that is 1225. Now what is the opposite credit for this? That is nothing but prepaid insurance. So prepaid insurance is an asset, right? So you already had the prepaid insurance, that will reduce by this amount 1225. So that is the entry for this.
Okay.
Now next one, fifth one, on December 1st collected 32,000 for consulting services to be performed from December 1st through March 31st. So the entire 4 months are there, right? December, January, February, March. So for 4 months, your revenue is 32,000. So, but right now, today is December 31st, for example. So only 1 month is over. So out of this 32,000 revenue, you actually earned revenue of 1 month. So that will be into 1 by 4, right? So that is like 8,000.
I don't get it again, please.
See, you are doing a project. Okay, so what is a project? This is what Hong Limited, December, Jan, Feb, March. So the cost of the project is 32,000. So cost of the project is 32,000, but so each month it will be 8888, right?
Yes.
So right now we are doing adjusting for at December 31st. So
Okay.
8,000 is already, see, this 32,000 is future revenue, right?
Okay.
Or unearned service revenue. So unearned, it is not yet earned, but in the month of December you earned 8,000. Remaining 24,000 is still unearned service revenue.
Okay.
So because you earned a revenue of 8,000 in December, you have to show that you earned a revenue. But revenue is a credit account, right? So sorry. So here uh, service revenue will be in credit, 8,000, and unearned service revenue here debit will be 8,000. So when, because revenue is a credit, like revenue increasing means you have to put it in credits. Okay, so that is why it is. Okay, let me just explain that. See, there is some time back I mentioned, right? Dealer, DEALER.
Yeah.
So dividend, expense, and assets. Here increase means debit.
Okay.
So liability, equity, and revenue. Here increase means credit. So if it is a liability or it's a equity or it's a revenue, if it is increasing, that means you have to put it under credit. Whereas if it is dividend or if it is any expense, see what is the expense? For example, here if you see depreciation expense, depreciation expenses are increasing. That's why we kept it under debit. Interest expense is increasing. That's why I kept it under debit, like that. Whereas the liability, okay, liability is increasing, you put it under credit. So that's why here you see interest payable is a liability, that is under credit. Supply is a asset. Now here supply is decreasing. See what is happening, you are consuming the supplies, right?
Mm.
So supply is an asset, but supplies are decreasing, therefore it comes under the credit side. So here revenue is increasing, so it comes under the credit side, because here you can see revenue increasing means credit, like that. Anyway, let's come back here. Let's do the sixth one. Hong performed consulting service for a client in December, and the client will be billed this one. Okay, so the you already earned this revenue, but you are not yet received the money. So it will be accounts receivable, and accounts receivable is an asset. So asset is increasing means it will be in debit. So here you can say accounts receivable, accounts receivable by 4200. Okay, and then this is for what services, service revenue 4200. Again it is clear, right?
Yeah. The most confusing me is like how I know it's account receivable or service revenue
Okay.
or
Okay, I'll tell you.
s-
There's one more way. See, if you look at this sixth one, consulting services is mentioning, right? This is the keyword, consulting services. And he's earning a revenue, right? Because when you perform a service, see, perform is also there, perform consulting services. Now your revenue is increasing. So you know this one, service revenue credit. Now you have to find some asset side which will increase. Cash you cannot increase because cash is not yet paid. So accounts receivable you have to pay like that.
okay.
So you have to identify at least one of the transaction, then you can get that.
This one what I want to know the keyword of everyone
Yeah,
because this is what's confusing me actually even in the first one the expense. So
yeah.
this one what the
See,
keyword I want.
if you look at the first one, since he's talking about a loan, okay, borrowing, and he's talking about when you take a loan, what happens? You have to pay interest. So that means
Yes.
interest expense. So when
Okay.
you,
So
yeah, when you
borrowed.
consume the supplies, that means supplies expense. Whenever depreciation is mentioned, depreciation expense.
The fourth one.
Yeah, in fourth one, you already paid. So let me draw a diagram for the fourth one. Okay, see what you have done. Uh, June 1st. Okay, then you have July, August, September, October, November, December, and more. Jan, Feb, March, April, and May. So June again is there, 1 year. Okay, so how much you paid? So the amount paid was 2100. Okay, so on 1st June, 2100 paid for insurance. Insurance for 1 year. So if you pay 2100 for 1 year, the 2100 will be for each month you are consuming that insurance, right? You are paying before itself, but its benefit will be there until one year. So in the month of June, it will be 2100 by 12. In the month of July, 2100 by 12. In the month of August, like this, each month, your whatever you already paid, that you are utilizing it. So, so your actual expense is this one in this month. Actual expense this one in this month, like that. So up to December 1, 2, 3, 4, 5, 6, 7. So it will be 7 into 2100 by 12. This is the up to this 7 months. What is the expense? That is the insurance expense. So your insurance expense will come here, and debit will be 1225, and prepaid insurance will be credited by 1225 because prepaid insurance is an asset and that should reduce.
Prepared insurance. This is the first time I heard about prepared insurance in it's in asset. Because if, what I know in asset is just cash, supply, and equipment.
Okay, so good. So there is a I'll in this textbook, if you see, if you open, there is a this thing, chart of accounts. Can you see this?
Yes.
So what all can come under assets? Cash, accounts receivable, allowance for doubtful account, interest receivable, so inventory, supply. So everything that usually comes under the what you call assets is under here. Usually what comes under liabilities? Usually what comes under equity? What kind of revenues are there? What kind of expenses are there? So different kinds of expenses. So you can see insurance expense, income tax expense, freight out, depreciation expense, cost of goods, amortization expense, maintenance, repair expense. So all examples are given here. So I think I will take a picture of this, and I will send it to you. This one you can
Sure.
stick it onto your wall or somewhere, and you can refer some time to
Yeah,
time.
this is what I want exactly.
This is useful, right?
Useful, very useful. Thank you.
So now you will not get confused. So for example, bonds payable, interest payable, salaries, wages payable. So all payable things, everything is here. Mortgage payable. So whether if you don't know whether it is asset or liability, you can refer to this. Yeah, I'll just send a pic on WhatsApp later. Yeah, so I think last one, let's finish this and we'll. So Fong pays employees total salary of 9,000 every Monday for the preceding 5-day week. On Monday, December 29, employees were paid for the week ending December 26. All employees worked the last 3 days of 2020. So I think again we need to make a small calendar here. So we have Monday, Tuesday, Wednesday, Thursday, Fridays. It's a 5-day week, so Saturday, Sunday, don't worry about it. Now, what he's saying is on Monday, December 29. Okay, so December 29 is a Monday. So 30, 31. Okay, so this is for the December. Now, if I go to the previous week, so 29 minus 7, it will be 22. So 22 will be Monday, 23, 24, 25, 26. Okay. So work done on this week, salary will be paid on Monday. Okay. So your work. So what is the salary? Weekly salary that's mentioned here, 9,000. Okay. So you get, it's a good job, $9,000 per week. Maybe for all the employees, maybe I don't know. Yeah. So now that means per day it will be this divided by 5. So we need to worry about 3 days. So what is the salaries expense or salaries and wages expense for 3 days? That will be your salaries and wages expense, and it is not yet paid. When it will be paid? It will be paid on this is first, second, and third, fourth, 5th January. It will be paid. But up till here, it will be as a salaries payable. Yeah. So now for 3 days, it will be 3 by 5 multiplied by 9,000. So the money to be paid for 29, 30, 31, the 3 days. So it will be 3 divided by 5 multiplied by 9,000. So that is about 5,400. So here,
But he not said December. He said like
but see, we are preparing the what you call adjusting entries up to 31st December. So up till here, 3 days people have worked. So I am supposed to pay salary for these 3 days. So the salary expense is there. Expense will be debited, and liability will be what in that the salary is payable. That will be credited. Okay, so I'll show you. So here what you can do is 31st. So salaries and wages EXP expenses. So this expense will increase by 5,400, and then salaries and wages payable 5,400. So this completes the last transaction.
so. That's it, or do we need anything else?
So that's what was asked in this. Prepare the adjusting entries for the 7 items described above. So these are the adjusting entries. So the question asked up to here, but then later it will go, these all will go into the T accounts, and from there you will do that. That's another step. But in this question, it is that's it.